Hi there, my name is Curly Johnson and I'll be taking you through another math fundamental. The title of this unit standard is Use Mathematics to Investigate and Monitor the Financial Aspects of Personal and Community Life. Unit Standard 7469, NQF Level 2, 2 credits. So our specific outcomes for this unit standard are: use mathematics to plan and control personal and or household budgets and income and expenditure. Use simple and compound interest to make sense of and define a variety of situations. Our first topic is income and expenditure. Let's begin with income. Income is the money that's always flowing in. That can range from our salaries, our wages, to even the interest we receive in our bank accounts. So let's look at a simple example. Mike earns a salary of 5,000 Rand at the end of this month from the company he works for, and 1,000 Rand from his investments. Therefore, we can say that Mike's income for this month is 6,000 in total. How do we know this? 5,000 plus 1,000 equals 6,000 Rand. So now let's look at expenditure. Expenditure is the opposite of income. It is not the money flowing in, but it's the money flowing out. So some examples of expenditure may be your rent, taxes, even a sweet that you buy at the shop, because money is flowing out. So let's take a look at a practical example of expenditure. So Mike buys a burger for 30 Rand from the store and paid his cell phone bill for the month at 200 Rand. Therefore, we can say that Mike's expenditure for this month is equal to 230 Rand, because 30 Rand plus 200 Rand equals 230 Rand. So our next topic is drawing up a budget. We draw up a budget because we want to plan how to use our money. We need to know how much money is flowing in and how much money is flowing out so that we don't run at a loss. So there are 3 objectives of a budget. Let's take a look at them. Ensure that you spend less than you earn. Ensure that you save some money for yourself. A budget also, and lastly, ensures that you save money for a rainy day. So let's differentiate between the 2 types of expenses. We get variable expense, which is the expense which is not a consistent one. It changes all the time. It could be from your groceries, because this month I pay this much for groceries, next month I pay a little bit more. It's never the same. Whereas fixed expenses don't change from month to month. For example, rent. So I've drawn up Henry's budget. Keep in mind, there are many formats of a budget. For example, in the slides, it might look a little bit different to this one. However, they have the same concept. Just follow. So over here, we have the description of each of the variables. Over here, we have income. Over here, we have expenses. Okay, and these are the amounts. So Henry earns a salary of 4,000 Rand this month. So we put that under income plus 4,000 Rand, because income is a positive value because it's money flowing in. So keep in mind, Henry also had expenses such as rent, taxes, and groceries. We put this under the expenses column, and here are the values. So these are all negative because this is money flowing out of Henry's pocket. So let's get out our calculators. 4,000, positive value, minus 600, minus 200, minus 400 would give us 2,800 what? Rands. Don't forget the units. So what's important here is that Henry ends up with a positive bank balance. So what percentage of income has Henry actually spent on rent this month? So we take the rent divided by the income times by 100. 600 divided by 4,000 times 100 will give you 15%. Therefore, Henry has spent 15% of his income on rent this month. So we now know that Henry is spending 600 Rand on rent. Let's say Henry's landlord increases his rent by 20% for the following year. How much is his new rate? 20% of 600 is equal to 120 Rand. So his new rate will be 600 plus 120, and that will be 720 Rand. So how did I get to 120 Rand? 20% is equal to 20 over 100 multiplied by 600 equals 20 divided by 100 times by 600 into your calculator will give you 120. And that is how we got to this. So now our topic is simple interest. We define it as the interest that is earned on an amount over a long period and calculated at the end of the period only. So our 12-month period starts in January and ends in December. Our simple interest is then calculated at the end of the year only. So it is accrued or accumulated throughout the year and calculated in December. So how do we do this? Our formula for simple interest is P times T times R. P being the principal amount invested initially, T being the time in years, and R being the rate of interest per annum. So let's look at a simple interest example. Our principal amount is 2,000 Rand. Time in years, 2 years. Rate per annum, 15%. Our simple interest formula guides us by saying P times T times R, which will give us 2,000 Rand times 2 years times by 15%, which is equal to 0.15, will give you 600 Rand. But keep in mind, this is for 2 years. Therefore, if we are looking for the annual amount, the simple interest per annum is divided by 2, which gives us 300 Rand. Our other form of interest is compound interest, formally defined as the interest earned on an amount over a longer or even shorter period, and it's calculated daily, weekly, monthly, or even yearly. This interest is then repaid back into the account, and the interest keeps on being added accordingly. So simply said, compound interest is interest added on interest. So our formula for compound interest is A equals P, open bracket 1, plus R, close bracket, to the power of T. So A is the accrued amount, P is the principal amount, R is the rate of interest, and T, once again, is the time. So here's an example of compound interest. So Henry has 3,000 Rand in his account and wants to invest his money into an account to be compounded annually at a rate of 15%. How much money will he have after 10 years? So now we have all the tools to calculate Henry's accrued interest. P is 3,000, R is 15%, T is 10 years. Remember the formula? A equals P, open bracket 1, plus R to the power of T. Our next step is to substitute these values. P is 3,000 Rand. Open bracket 1 plus R. R is equal to 15%, which is equal to 0.15. So R is equal to 0.15. T, our time, is 10 years. So T is equal to 10. That means our A is equal to 12,136 Rand 67 cents. Therefore, Henry's investment has grown from 3,000 Rand to 12,136 Rand 67 cents in the span of 10 years. Our last topic for this unit standard is inflation. So every time I go to the shops, I notice that the prices of my meats are going higher and higher and higher. This really hurts my pocket, as I'm sure it does yours. Who do we blame this on? What do we blame this on? We call the concept inflation. So inflation is the overall increase in the price of goods and services over a period of time. Inflation also means that our money buys less from year to year. A high inflation means that we need to earn more each year so that we can afford the same goods and services we did the previous year. So here we put inflation into practice. This year, I buy meat at 150 Rand. If our inflation rate is equal to 5%, so to calculate the increase in the meat price, we say 5%, which is equal to 5 over 100 times by 150, and that will give us 7 Rand 50. So the price of meat next year is 157 Rand 50 cents. Don't forget your units. So my name is Curtly Johnson, and I want to thank you for joining me with this unit standard. Keep up the good work. I'll see you next time.